Hi, today I'd like to discuss how to read and understand your Schedule C on your Form 1040, your individual tax return. Schedule C is a form for businesses that are not required to file a return separately, like a partnership return or an S Corp return. It's for either single member LLCs or people who are not incorporated and want to report their earnings from their business on their personal tax return. And I'd like to show you how to read it and a little bit about it. So here's a copy of your Schedule C, and this is basically on the top over here is all the information about the business, including the name of the proprietor, which is the professor, the principal business service or product, which is, as you can see, bank robber, and you'll have the business name. This is not necessary. If the business has an official business name, you can put it here. If not, you can leave this blank. This is going to be the social security number for the individual. If it's an entity if it's a single member LLC, then you would put the employer ID number here. This is the code for this is basically called an NAICS code, and basically what it is a code to tell the government what type of entity it is, and you can look that up online for your specific business. Down here is the accounting method for the entity. So generally you'll see, small business people use the cash method. If you need to know, I can make a video about the difference between cash and accrual on it or other, but generally you're going to use the cash method, which basically means you pay expenses are expensed as they're paid, and income is included as it is received as income. So then there's a few questions. Did you materially participate in the business? Basically, are you involved in the business, and are you financially involved in the business? And then this is a question of whether you've filed any forms 1099, whether you're required to, and whether you have actually filed those. Down here is the main part. So you have the income section, which includes the gross sales, your cost of goods sold. Some entities don't really have cost of goods sold. Cost of goods sold would be items that are directly related to the purchase of the products that you sell, or if you have a service, then the labor associated with providing that service, and that arrives at your gross income, which is sales less cost of goods sold and returns and that type of thing. And then generally down here, your expenses are going to be your overhead, your other expenses that are not directly related to actual products. So you'll have your advertising, your car and truck expenses, and this is actually, if you have an actual car that you use for business, then it'll be on the second page, and this is basically the sum of that item. Commissions, some other items that most businesses don't have, insurance, interest, legal and business services, and then you'll have, which as you can see, bank robbers probably have lots of legal expenses, which is why this is so high. You have rental expense and travel, which if you're scoping out banks to rob, I guess you have to go to a lot of different banks and you have to travel a lot. It's the life of a person who's robbing banks. you have meals and entertainment, which is subject to 50% of the total amount. So if you spend $50,000 on meals and entertainment, you get a deduction for $25,000 of it. Other items that are basically, you have wages, which is actual physical salaries, utilities, and then a line for other expenses. Now down here you have something on an individual tax return that you don't have on a regular business, which is expenses for business use of home. And this is one of the main items that is a huge benefit to people that that work at home, and or sometimes work at home, and they can deduct a portion of their expenses for their office at home on their tax return. And it's one of the better benefits, and it's a separate form, and I'll show you a little bit about how that form works. Okay, so this is the form for business use of home. So basically how this works is you have the total area of your home. See, he lives a lavish lifestyle, so he has a 25,000 square foot home, and then you have the area you use for business, or your office. So you put in the 1,800 square feet and the total square footage, and that gives you the percentage of your expenses that will be allocated towards your business use of home. And down here you have your two columns. You have your direct expenses and you have your indirect expenses. Direct expenses are items that are directly related to that business, the home office. And these are indirect expenses, which means that they're for the entire home. So generally most of the items will be indirect expenses, like mortgage interest, real estate taxes, all that kind of stuff, insurance, repairs and maintenance, and other items. If you had, let's say, internet, and you only use the internet for business, then you could put that probably on this side as direct expenses. And basically it calculates this column and it multiplies it by line 7, which is your percentage of business use to total square footage of the home, and that gives you your allowable expense for your business use of home, and that goes back over here on your Schedule C. And that arrives, so that brings over here you had your total expenses, which you subtract from your gross income to arrive at your tentative profit, which you subtract your business use of home, and that gives you your net profit from the business. Now this number is going to go right back onto, well, actually first it goes to the Schedule 1, which I'll show you right here, and it goes to business income from Schedule C's on your Schedule 1, and then this number is going to go back to your page 1 of the return, which ends up right here on line 7A, which is your total other income from Schedule 1, line 9, which is that schedule that I just showed you. Okay, so a few other things about Schedule C that you should know about. The first thing is, on the second page over here, you'll see your cost of goods sold section. I did not fill this out because this wasn't exactly appropriate for this line of work. But if you sell product, and if you sell, for example, you sell cars, and you purchased a car and sold a car, your purchase of that car would be over here as purchases, cost of goods sold. If you, for example, have a business where you cut lawns, your labor for that cutting lawns would be, your cost of labor would be right here. Anything that's directly associated with the product or service that you provide is going to be in your cost of goods sold section. The next section on page 2 of Schedule C is your vehicle. So how this works is similar to the business use of home. You're allocating a percentage or all of your vehicle depending on how you use it. It's going to ask you for your business miles and or other miles that are not business related, and it's going to ask you a series of questions. You want to have the ability to back up what you write over here. The IRS is going to be looking for you to say that you have proof that the miles that you drove are actually business related. Basically, business miles, commuting is not considered business miles. If you go to work and if you go from home to your office, that's not considered business miles. Business miles would be going from your office to a meeting. That's considered business miles, or going between meetings, or just driving for an actual physical job that you need to do. Those are included. And the other option is that there are actually two methods of doing this. One is just doing straight miles. The other is doing expenses for the miles. I tend to find that just doing the miles, it provides a better result, and it's just a lot easier than basically calculating all the expenses that you had on the car over the year and figuring out whether it's business or non-business. If you just enter miles, it's going to calculate about 50 cents per mile and give you that as a expense. And then here are your other expenses, such as in this line of work, you have a getaway vehicle, face masks and wigs, very important. You don't want anybody to see you, crowbars, guns, and a first aid kit in case somebody gets injured. Now, another item, there are a few other items that I want to talk about that are associated with a Schedule C that are important that's important for a business owner to understand. The first item is self-employment tax, and I've touched on this a little bit in my other video. Basically, self-employment tax is the tax, aside from federal income tax, aside from your regular income tax you pay to the government, the net income that you have from your business is subject to 15.3% tax. Now, and that's going to be right here. So that's something to note when you run your own business, that you're going to have to pay an extra tax for your self-employment. And that's really just basically when you're a W-2 employee, you get deducted 7.5% from your paycheck, and your employer pays another 7.5%. It's really 7.65%. Your employer pays the other half, and the total is 15.3%. When you're self-employed, you have to pay both portions of that. So that's just something to keep in mind. And this is calculating that right there. And then you also, and this is very confusing, but try to follow me here. If you have a question, please ask in the comments and I'll explain further. Basically, half of your self-employment tax is a deduction from your federal income tax. So, and I'll show you how this works a little bit right here on page 1. So you see your income from Schedule C. You see adjustments to income, and this item right here is a deduction for half of the self-employment tax that you paid. So for federal income taxes, you're paying on a lesser amount because of the fact that your employer would have gotten a deduction for your half of the self-employment taxes, for the half of payroll taxes that they pay. So now you're your own employer, so you get the same deduction to arrive at your federal income taxable amount. And then they add back the self-employment taxes below, and that's the full amount. It is a little bit confusing. I hope I explained it well. If I didn't, please let me know in the comments. Okay, one other thing, and this is pretty new, and I've talked about this as well. Basically, when you have your own business, or you have business income like a K1 or something like that, and it's a qualified business, you get a deduction on your return for about 20% of your qualified business income, which in this case is $10,000. And it's a complicated, I don't want to go into it to confuse anybody, but it is important to understand, because on your page 1 of your return, you're going to see that right here you get another deduction for qualified business income deduction. This is kind of a new thing. It's been since 2018, and it's a bonus basically that the government gives you for running your own business. They want to encourage people to start businesses, so you get this as a deduction on your tax return, and that's a nice little extra. I hope that this really explained everything about a Schedule C and how it works. If you have any questions, please leave it in the comments below. I'd love to make another video on something else that you don't understand in regards to taxes. If you like this video, please like and subscribe and share the video, and have a great day.